Welcome back to Dividend Investor. I'm back today with another video in my series, the Dividend Stock Analysis. In today's video, we're going over the dividend stock Verizon, ticker symbol VZ stock. But before we get into it, guys, if you could subscribe to my channel if you haven't already. Like this video, get in the comments as well. Let me know what you think if you own Verizon in your portfolios. And just let me know what you think about the video in general. So obviously Verizon Communications is obviously going into a bit of the information about the company. Offers information on entertainment products and services to consumers, businesses, and government entities worldwide. So a little bit more of the key information about the company. Verizon Communications Inc., ticker symbol VZ, on the New York Stock Exchange, founded back in 1983, integrated telecommunications services in the telecom sector, with a massive market cap of $239.71 billion, with the current outstanding shares of 4.14 billion. They currently have 135,000 employees of March 31st, 2020, so that's quite recent. A lot of employees worldwide. Location is in New York, America, in the United States. And obviously the listings of what different stock exchanges they're on, but we're going off the New York Stock Exchange today. Let's just have a little bit of a look at the health of the company now, guys. So the financial health, they get a 3 out of 6 score. The short-term assets of 40 billion do not cover its short-term liabilities, with 41.1 billion. Score number 2, short-term assets. Bear with me. There we go. The short-term assets don't cover its long-term liabilities. So liabilities are good, liabilities are bad. Sorry, assets are good. If you don't know that, I'm pretty sure everyone watching this will know that. Verizon's debt-to-equity ratio of 191% is considered high. So they're the first 3 blotches on the scorecard, so they're bad. So now look at the good ones. Its debt to equity, it's a tough word to say. Debt to equity ratio has been reduced from 1,052% to 191% in the last 5 years. So obviously, debt to equity is equity is assets and other good things that the company has. Money, obviously, physical assets as well. So that's gone down, which is good. The debt is well covered by operating cash flow of 31%. So again, that is really good. So obviously you know that the money that they're making is covering any debt that they have. The payments on debt are well covered by EBIT 6.29 coverage. You can see, guys, short term, pretty even. Liabilities slightly higher, but in the long term, the assets do outweigh the liabilities, which is always good for if you're a long-term investor. Right, so that's the company's health, guys. So now have a look at the main bit of the video of the dividend stock analysis. We'll check out the dividend of Verizon. So as you can see, Verizon's dividend is a 4.25 dividend yield, and it gets a 5 out of 6 score on the Simply Wall Street analysis check. So the first one, obviously, it has a 4.25% yield, higher than the bottom 25% of the market dividend pays in the US, which average at 1.9%. Score number 2, it's 4.2%. Dividend yield is low compared to the top 25 dividend payers in the US market, which average at 5.22%. That's the only blotch. Again, anytime I see that on any of these stocks that I cover, I don't really see it as a blotch. As not always the higher the dividend, it's not always the better. So I think Verizon is a nice solid almost 4.5% yield. Its dividends per share have been stable in the past 10 years, so they've not cut them or they've not decreased any payments at all, which is good. Especially at this moment in time, guys, when companies are cutting dividends, you really see who the solid companies are, who have the financial clout to get through these bad times in the economy. Score number 4, the dividend payments have increased over the past 10 years, which is good. You always want to have a dividend that's growing, even a little so slightly every year, but the main factor is it is growing. Score number 5, with its reasonably low payout ratio of 41.2%, Verizon's payments are well covered by their earnings. So obviously they're not going into any more debt, paying out shareholders. Obviously, if they're paying the shareholders more the shareholders will buy more shares and obviously keep that cash flow going as well. And the score number 6, finally, the dividends in 3 years are well forecast to be covered by their earnings with a 50.8% payout ratio. So it's a 5 out of 6 score. I say anything over 3 or 4 is really good. So Verizon gets a 5 out of 6 check. Another one I own in my personal portfolio. I want to be adding more shares to as well. Really one of my top dividend paying stocks. I really like the company. So yeah, that is it for the video, guys. Just let me know what you think of Verizon as a whole, as a company, if you own them, if you're looking to purchase them, and if this video helps guide you to buy them. Obviously, I don't want to give any advice out to anybody, just this is my personal opinion. So do your own research. I'm not a financial advisor or anything like that. So, yeah. But anyway, that is it for today's video, guys. So I'm going to leave you on that. Hope you enjoy the rest of your days. Take care.